Welcome to the current federal tax developments for June the 15th, 2020. Current federal tax developments are brought to you by the Kaplan Financial Education. I always want to change that the wrong way. And also by your state society of CPAs. I'm Ed Zollers, and I'm going to be talking to you this week about a number of changes. We have a couple of pieces of guidance that relate to the new paycheck program, the Paycheck Protection Program Flexibility Act that was passed by Congress a week before. We got some initial guidance from the Secretary of Treasury and the SBA Administrator. We now have gotten some more guidance that kind of lets us know officially some of the changes that have been made to some of the guidance we had back in the original program. We're also going to talk about some relief that we're going to get this week for programs where employers allow employees to donate time to COVID-19 related programs by donating their leave time, which then turns into a charitable contribution. That's a kind of program we've seen before with disasters. The IRS has rolled one out now. We also got a pair of proposed regulations, one dealing with medical expenses and one dealing with the major changes made in the Tax Cuts and Jobs Act to 1031 exchanges. So at this point in time, we're kind of looking at a lot of things that have been going on, and we're going to take a look, get going, and get a few things started. So let's go ahead and start with our first development this week, and this will be basically an interim final rule issued by the Small Business Administration related to the Paycheck Protection Program Flexibility Act, the PPPFA. This is RIN 3245-AH49, titled the Business Loan Program Temporary Changes Paycheck Protection Program Revision to First Interim Rule, issued by the Small Business Administration on June the 10th of 2020. As you may remember, we've had a few things happen here with the Payroll Protection Program. We had the initial version. Some people now have gotten upset because they said we didn't have enough time. There are various other things. So Congress went back now and has decided that we're going to go back and make some changes to the program. Now, that's all well and good. We know it was in the bill now. But now we have to wait for the SBA to actually tell us what exactly this bill is going to mean. So the first thing that we found, of course, was that we got this week the notice, and this is just the first one. We certainly expect we're going to have other guidance coming from the SBA in this area. But this was an IFR modifying the first April the 2nd IFR that essentially told us how we were going to run the program. The April 2nd IFR was issued very shortly after the original program first opened. So this was the very first set of guidance, and this had some major issues for getting loans. That's what we're looking at covering now, is some more of this guidance about what happened when we got a loan and how we're going to make that work. So one of the key things we got, which was a real concern we had in this program, the way that the language of the Act read, it said to receive loan forgiveness under this section, an eligible recipient shall use at least a 60% of the covered loan amount for payroll costs. Now, the problem is, when you read it that way, it sounds a lot like we should have a cliff. That is, if you got a $100,000 loan, you should only be able to get forgiveness for anything the way it was written if you spent at least $60,000 on payroll costs. And last week I mentioned that we talked about the actual bill. With this language, it looked like we were getting a cliff. Now, the good news is that the SBA has decided. They're a little strained, and if you read their justification, get strained, but they have decided now that we're not going to have this cliff, that this cliff will not exist for loan forgiveness. So basically, what's going to happen here is just like before. No more than 60% of your forgiveness amount can be payroll costs. So roughly what's going to happen is if you spend, $60,000 on payroll costs, you're going to now, on your forgiveness application, divide that $60,000 not by 0.75 as you did in the original program with the rules we had, but rather by 0.6. When you do that, that's going to allow you to get a maximum forgiveness of $100,000. Now, obviously, if you didn't get a loan for $100,000, you're not going to get forgiven $100,000. But it does give us the maximum. And if you didn't spend at least $100,000 on covered items, so you had to have at least another $40,000 on things that are covered, then yeah, you're not going to get the relief. But it does say that at least it's not a cliff situation. That was a major concern of Senator Rubio, given the way the law was written. That's also been a concern, obviously, of everybody else looking at it like, yeah, that's, the SBA finally said we didn't have a cliff. Now you're coming back and telling us we've got the thing. But it turns out we're not going to have that. So other big thing that happened was we also found out that the term of the loan, the maturity date for PPP loans, they are going to be, the law said they had to be at least 5-year term. The SBA has decided for simplicity that a 5-year term basically is going to be also the maximum and the minimum. So your loans now that you get that are approved, and the SBA used the term approved here. If your loan is approved on or after June the 5th by the SBA, you get the 5-year term. If your loan was approved prior to June 5th, even though it might not have been funded until after June 5th and didn't get to your bank account, you're still under the 2-year rule. Now, the law does say, and so do these rules, that nothing prevents a bank or a taxpayer from essentially, deciding to pick up these amounts or basically change their loan numbers from 2 years to 5 years. The problem that we're going to have, though, is there really much incentive for a bank to take on an additional year of a 1% loan? I think we may find that that's going to be the bigger problem. It's not going to be so much that maybe the borrowers wouldn't mind it if they have any part that won't be forgiven. But I think getting your old lender to change it, that could be a lot more interesting. One other thing the law changed, and the rules just basically came along and went along with it. So we're going to now update and exchange our deferral period. That's a period under which we don't make any payments for anything on the loan. And the old law had a 6-month period. The new law for the PPP loan says you won't pay anything until either the date your loan is forgiven. So we're going through the SBA, we're going to get the formal forgiveness process, and when they finally decide you're forgiven, you're not forgiven, you're partially forgiven, at that point in time you would have to start paying. Now, obviously, if the law just said that, the solution would be, of course, well, we just won't ever apply for forgiveness, right? I'll just sit here, wait forever, won't apply for forgiveness, and it won't matter, I'll never have to pay. Congress figured that you might do that. So what they said was, if you don't apply for forgiveness within 10 months of the end of the covered period, which will now be the new 24-week period, we're going to start paying then. So the way this works, though, to understand it, is that if you apply for forgiveness, so let's say that you've applied for you apply for forgiveness on the day before the 10th month ends. That's still going to allow you to get up to 150 days before you have to start paying the loan, because since your application went in before the 10 months ended, now we wait to see when the approval process ends. Now, the approval process, the bank has 60 days to decide, and then the SBA has 90 days to decide to up or down what the bank's done or change it. So you could conceivably have 150 days to work with. So, that may very well be something that you're going to think about. Some people who are going to have payments coming later might seek to defer. Remember, though, while we defer this, it does not defer the time period. It doesn't stop interest from running. So if you do stretch out that, you're going to have a higher interest payment coming. And apparently the 5-year term of the loan will still be 5 years from initial issuance. So your amortization would probably also be higher if you delayed and waited on your payments until you got 10 months plus up to 150 days afterwards. Now, of course, if you actually have none of the loans can be forgiven, then I will bet it won't take 150 days to get a total turn down. But whatever works for you, we'll go there. The next item up, we're going to talk about, this actually came out before and told us about the IFR coming, and a lot of what they talked about in this release did deal with what's in the IFR, but it does have other stuff besides the IFR. This was a joint statement by Treasury Secretary Mnuchin and by SBA Administrator Carranza that was regarding the enactment of the Paycheck Protection Program Flexibility Act, and it was issued on Department of Treasury's website on June the 8th. So basically a week ago. So at the very beginning of the week, we got a notice posted on the website telling us about what they were planning to do. And this actually told us about a few things that we weren't aware, or we weren't for sure how we were going to interpret things. And so that gives us a little bit more to work with. One of the first things on there was we were told there was going to be no cliff rule. Now, I've already mentioned, we've told you about that already, that there is no cliff rule. That was in the IFR. The IFR just formally followed what we have here. Now, one other thing that happened in the loan was that before it got passed, Senator Johnson of Wisconsin was concerned since it said the PPP loan period, basically the covered period for PPP loans, which is under Section 1102 of the CARES Act, said the loans would, basically the covered period would go to the end of December. Senator Johnson was concerned that that could allow people to basically apply for a loan right at the end of the year under these terms, well after we may be outside of any of the issues. Again, that's highly speculative where we'll be in December, but at least conceivably the problems, could be greatly reduced by December, and somebody could just go, in that case, for quote-unquote free money. So Senator Johnson was concerned, he didn't really think that he did not want to vote to extend this past June 30 for getting a loan, and that was holding up the unanimous consent. As we told you last week when the bill was passed, essentially Senator Johnson got the assurances from leadership of the House and Senate that they did not intend to have these approved beyond, to have loans going out all the way to the end of December. And what happened in this statement, and though we don't have an IFR to back this up yet, but the Treasury said that yes, the SBA and Treasury said the Small Business Administration will not approve any loans after June 30. Now we'll see when an IFR comes out if they mean your application has to be in by June 30, or if they mean literally, if they don't get to your application by June 30, even if the bank had approved it, you're out of luck. So we'll have to see how that goes. It's not clear. Obviously, what we do know is the clock is running. If you've got a client or you yourself, your business yourself, wants to get a PPP loan, you better go get the application process moving. Also, you'll probably discover right now that it is much more difficult to find some lender who's still willing to write PPP loans. Most of the big lenders have pulled out now. They're saying we've already written all the loans we want to write. There are still a few small lenders or a few various things. I don't know if Paychex and Intuit, PayPal, if they're still doing it. I think they are, but that's kind of open. You have to look a little bit. You can probably still find one, but don't just assume that your bank is going to write the loan today. You need to start looking. You don't want to wait till just before June 30 if you want to get this loan. The release also told us what we already know, that the covered period could be up to 24 weeks. Now, they don't mention there too much about what that does to our problems when we talk about, which is probably the more significant issue. Right? Yes, we've got 24 weeks to spend the money, but the real question is, what's going to be the measuring period for retaining full-time equivalents? Are they going to give us some sort of floating 8-week period, or, the way I read the law, are we now going to have a full 24 weeks that we'll have to maintain full-time equivalents and have the test for we didn't reduce payroll during that time period, which could complicate qualifying for forgiveness? Again, the law seems to reference everything back to covered period. The other thing we don't have an answer for on this is we don't really know at this point, what happens to the limits on compensation to owners. Now, I think the way the law is worded, it should be pretty clear the maximum gets tripled so that we'll have 24 divided by 52 weeks times 100,000 for the maximum for any employee. But the question really becomes at this point, what happens to the owners? Remember, they were capped at 8/52 of last year's earnings. I certainly could see a theory that the SBA would decide we didn't get the loans any bigger, and so we don't want owners taking all the money for themselves. So we're going to go ahead and maybe keep the 8/52. I'm hoping that's not what they do, but I wouldn't be totally shocked if they did. Like I said, I'm thinking they'll probably let us increase that number. But if they didn't, I also I can kind of see them doing that. They certainly have acted as if they have enough flexibility to put those sort of limits in. So, yeah, be aware of that. They don't tell us a whole lot here about what goes on, but there are two brand new safe harbors that are supposed to stop us from having to pay if we have a reduction in full-time, basically in FTEs. So remember, the two basic rules we have here are new safe harbors. One of them deals with if we cannot rehire an employee that we had on February 15th of 2020, and we can show that in fact that rehiring just, it's not possible, and we're unable to find a replacement employee by the end of December. Now, the bad news about this is we've got so long to do it that tells me that that's going to be a little tougher to clear. But if that happens, then of course we are able to not get the hit for having FTEs down. Now the other catch is we also are going to have a second safe harbor that looks at where we just can't put the same number of employees in because we have COVID-19 safety issues that are arising that have kept us from being able to maintain the same type FTEs. I was reading just yesterday that 2 restaurants that have reopened here in Phoenix that are very near our office here, in fact, they're like, less than a block apart from each other, as I recall, that both of them have discovered that they reopened. Then they discovered that in one case, clearly it's an employee. In the other case, it's not clear who. But they end up with a COVID-19 positive situation in the restaurant, which has caused both of them to shut down, to get every employee tested, right? And then to turn around and get everything cleaned, and then they're going to have to wait to reopen. They're not required to do so by Arizona law, but it is a recommendation from the CDC. Remember, if you cannot get back to FTE numbers that you had before because of this sort of safety, sanitation, social distancing thing, and you're doing it in compliance with government recommendations, the law did not say government mandate, right? Obviously, a mandate would be a recommendation, but kind of recommendation you better follow. But you could have something where, just like what's happening here down the street from us here with a couple of restaurants in the Arcadia area of Phoenix, it was reported this week, if you are maybe not required to, but you go out there and you actually do it, that if you had a reduction in FTEs because of that, that should seem to also cover this situation. So hopefully, we're in good shape on that, right? The next thing up besides that we have here is they did tell us this is where we found out for sure it would be a single 5-year period. Remember, for the loan terms, and also that it was going to be on the cutoff date of June 5th based on SBA approvals. Now, remember, the law still says that it would be no less than 5 years and no more than 10. The SBA has continued, though, to like a standard number in a standard loan. So while we used to have 2 years, now we have 5. Now, again, remember, anybody who got a loan before June the 5th, that loan is still a 2-year loan unless the lender and the borrower agree to rewrite it. Now, I don't see a whole lot of reason why the borrower is going to be upset unless that somehow blows our ability to only use an 8-week testing period. But I certainly could see why the lender is not going to be thrilled about doing that. So, yeah, we're going to have that particular issue. The other thing they mentioned in this particular release was they reminded us that we're going to, again, stretch out that deferral period. They talked there about the, deferring the payment of interest, principal, etc. on the loan. We're going to delay that payment until either we get our formal approval of forgiveness or basically we go more than 10 months after we ended our covered period for the 24 weeks without having applied. So either of those happens, we start paying. So again, not going to have to start paying loans very quickly. So this could get just a little bit interesting in terms of timing, how things are going. Could cause some interesting problems too when you talk about, and I know I'm going to be teaching a course this week. It's actually a gap course. And one of the things we'll talk about, the course we're going to be doing in Oregon this week, is going to talk specifically about, the issues of recording these PPP loans under gap financials. And this could complicate the longer term delay here, could make it a little more interesting in how the reporting issues come down. So anyway, but today's session is on tax, so we're not going to worry much about that difference. Well, let's get off the PPP loan program for a second, but not off COVID-19 issues. And we're going to talk now about Notice 2020-46. Notice 2020-46 essentially deals with the case where an employer sets up a program that allows employees to donate time off. It could be sick time, any sort of leave time. But in essence, say, I'll take a reduction of my time off, and the employer will make a contribution for the value of that time to a charity that is giving COVID-19 relief. We've seen programs like this approved by the IRS when we've had hurricanes in the past, certain natural disasters. This is just an extension of that type of program. The key problem we've got here is without the relief we have here, if I tell my employee, yeah, you know what, if you want to give up leave time, I'll go ahead and make a charitable contribution to, I don't know, whatever charity you want. Generally, that would be viewed as me giving the employee essentially the cash equivalent of that leave time, and then the employee making a charitable contribution. So a couple of hitches there. It would increase the employee's AGI. It would also be a paycheck that is subject to payroll taxes. What this relief does is does what we've had with the other programs they've done in the past, where we've had this donation of leave time. And what's going to happen now is that the amount received is not considered constructively received by the employee. It will not be taxable as wages to the employee. So the employee gets so the employee's not going to pick up the income. Now, of course, that also means the employee can't claim a deduction for the amount paid. You can't have it both ways in that scenario. But we are going to be able to not have to pick it up in income. And the flip side of it is from the employer's side, the employer has no payroll tax liability on it, and the ruling says the employer may treat it as appropriate, a trade or business expense or a charitable contribution. Now, they don't really explain how you decide the difference in those two, which one it is. If it's a charitable contribution or if it's a payroll expense, I guess it's kind of the facts matter. Probably for most employers, they're going to treat it as a payroll expense. Now, the other thing to remember is this doesn't tell us how this would interact with mandatory leave laws. And they didn't even explain how it would interact with, because probably it's outside their area, the issue of the mandatory COVID-19 sick time. My guess is you cannot donate that. My guess is also if you're in a state that mandates leave time, you probably shouldn't be able to donate the leave time that represents the state mandated amount. They have to still leave that. So employees could donate the other. I guess they could still donate, quote unquote, the other time, but if they got sick, you'd be kind of forced to pay it up. So, yeah, not exactly a simple solution, but it's there. Okay, let's go on now to the two sets of proposed regs we got this week. And what we got this week was we got a proposed expansion of deductible medical expenses. And this was in proposed regulation, would be under 120 or under 213 regulations. And the regulations are going to deal with what's considered deductible and medical expenses. And what this ruling will do will be add as deductible medical expenses two things: direct primary care arrangements and health care sharing ministries. Now, direct primary care arrangements, it's defined in the ruling as essentially a contract between an individual and one or more primary care physicians under which the physician or physicians agree to provide medical care for a fixed or periodic fee without billing a third party. So what's happened is you've entered into what's effectively a flat fee payment arrangement with a physician. So you make this flat fee payment arrangement with a physician, you pay them X dollars for the year, and they agree to provide, certain types of treatments for you. Now, the problem there is trying to figure out what that was, because you haven't actually paid for any expenses and you may never get it. Is it insurance? What is it? It's not really insurance. And one of the issues they've got here is there wasn't a good definition of what's insurance as well that existed in the code. There were a lot of some regulations from the 50s, and then we had a lot of additional sub-regulatory guidance in the interim that told us things like when we talk about HMOs, health maintenance organizations, which also didn't really quite fit the traditional medical insurance titles, that we had ruled that those were insurance. Well, they do have some information or say some language in here to hopefully clean that stuff up as well and make it a little clearer what is medical insurance. Now, the other item here, as I said, is this category that we call the healthcare sharing ministries. Now, healthcare sharing ministries was something we first really ran into or got really worried about in the Affordable Care Act. And Section 5000 Cap A defines one, and it's got to meet basically the following 5 criteria. And the regulations use these 5. It's got to be a 501c3 organization. It's got to have members of which share a common set of ethical or religious beliefs, right, and share medical expenses among its members in accordance with those beliefs and without regard to the state in which a member resides or is employed, the members of which retain membership even after they develop a medical condition, and which or a predecessor of which has been in existence at all times since December 31st, 1999, and medical expenses of its members have been shared continuously without interruption since at least that date, and which conducts an annual audit performed by an independent CPA firm in accordance with GAAP and which is made available to the public upon request. Now, obviously, first takeaway from that is you can't form one today, and it's, these are out there, but obviously, we're not able to add them. Now, a couple of interesting asides is that what the IRS has ruled, though, in both of these cases, payments in either of these cases will become deductible medical expenses. And what that'll mean, that actually gives us a couple of issues for them. Number one, obviously, they're allowed on Schedule A, and that would be one of the cases. But number two, we also would expand the list potentially for things that could be reimbursed by a health savings account, things that could be reimbursed, not really by an HSA. HSAs are kind of messy here. We're going to kind of get into that. But it could meet things for flexible spending accounts in some cases. Now, let's talk about this. Now, as I said, one complication, though, is obviously how these fit in, because the problem is, are these insurance or are they not? And then it becomes an issue that could cause major complications if you have an HSA account. Because remember, for a health savings account, you have to have only high deductible health premiums, high deductible health insurance program, and you cannot have any other disqualifying insurance. And so one of our questions is, how that's going to work. Well, the IRS is asking for comments on a couple of issues here. First, the IRS is asking for comments on whether non-primary care options should also count. One of the key limits here is for the primary care, you have to be a primary care physician. So specialists wouldn't count, or dentists wouldn't count. So they're asking for, should this be expanded to cover specialties? Should it be expanded to cover things like dentists and that sort of issue? Or, how should we do this? My guess is to be a pretty good chance when they actually take these final that they would expand to cover those. The other issue is they do ask about healthcare, about the question of a healthcare sharing ministry. And they want to know if we really should continue to use the ACA definition. Now, obviously, I think some of what we're going to talk about there is there'll be a push from some organizations to try to expand the concept, see if they can do it by regulation. The IRS is obviously, I think, borrowing from the code because that's a simple, clear definition that existed and it's already been in place. Now, as the IRS notes, that definition doesn't really matter now. Because that only said if you paid into that, you didn't have to pay the shared responsibility payment as an individual. Well, nobody has to pay anything there anyway, so it's kind of a who cares. But finally, they do have a discussion here where they talk about how these things interact with HSAs and with HRAs. Now, the first thing they explain to us is a direct primary care arrangement in HSAs. And they do that because I think, honestly, for HSAs, clearly that's our concern. Do they make them no good, right? And this particular issue. Generally, they're going to say that if you have a direct primary care arrangement, that looks an awful lot like insurance. As such, that would be disqualifying coverage in most cases. However, there may be limited circumstances where your direct care arrangement is limited to accepted benefit type issues, right? So for those issues, for things that are disregarded or preventive only, they said in that case you could have a direct primary care arrangement that comes under this rule and not blow your ability to have an HSA. But they also make clear if that direct primary care arrangement were to be paid for by an employer, regardless of its structure, that will be disqualifying other employer group coverage, which is going to kill it. So if an employer pays for a direct primary care arrangement, first thing is it does appear to be fine. It's medical expenses. Whether it's insurance or not will get really interesting, but we'll deal with that a little bit later as to how we structure it. But they are saying that would blow your ability to have a health savings account. So you can't do this and an HSA. Well, you could do it and an HSA if you had a very limited version and the employer doesn't pay for it. But if that's not the case, then yeah, we got a problem. The other issue is to talk about health sharing ministries for HRAs, a health reimbursement arrangement, right? This could be paid for by an HRA. So they talk about the issues there when an HRA could pay for this, pay for premiums for health sharing ministry. That's fine. However, they also make it very clear. A health care sharing ministry membership will always disqualify you for making a contribution to an HSA. So whatever you do, if you want to have contributions to an HSA, you cannot be a member of a health care sharing ministry. That's simply not a possibility, not going to happen. Now, finally, we're going to talk about something here that's occurring from the Tax Cuts and Jobs Act. And what's happening is, you remember that bill? It seems like a long time ago. Well, it was a while back, right? Back in 2017 that we passed it. So, it's been a couple of years, but we had never yet gotten guidance on how to deal with the changes the law made to like-kind exchanges under 1031. This week, the IRS put out proposed regulations that the key thing they add is proposed reg section 1.1031-3. They add a brand new reg. And this regulation is to deal with this fact that now we have real estate only can qualify for a 1031 exchange. And one of the key problems we've got with that is you got to figure out what the definition of real estate is. Because if you can only exchange real estate, then the question becomes, what is it? Now, interestingly enough, they have a long discussion in the preamble about the fact that there are lots of different definitions for real estate that we find in the Internal Revenue Code, and in regulations. But they say they're all different. And also, none of them quite agree with what the committee report suggests that Congress was looking at for this category. So because of that, the regulations decide that we're going to have brand new separate definitions for 1031. Now, they're related to the other definitions, very similar in many ways to many of the other definitions, but a couple of things to note. First thing is, they tell you right off, you cannot use this definition for any other provision in the code. So don't take this definition of real estate and then start using it for something like deciding depreciation methods. Don't go use it for anything else where real estate matters in the Internal Revenue Code. Look at the definition for the section in question. Number two, they also make clear these rules have nothing. These rules are totally independent of local law. It doesn't matter what your state or your city or whoever defines as real estate under various legal principles or under various laws, maybe for property tax purposes. It doesn't matter what your state calls it. Real estate will be defined the same across the country, and it's going to be defined by these regs. These regs are a federal-only definition. The fact that your state may have a different definition for other purposes is great, but not terribly relevant. So what is this definition of real estate? Well, they come up with a few things here. The first thing they tell us is, obviously, real estate is land. And they don't spend a lot of time defining land because they figure we got that. And really what's going to happen here is you start with land, and everything either is going to be attached to land, directly relate to various rights on the land, or be attached to something that's attached to the land. That's kind of how it goes, right? So it's going to be one of those sorts of things. So there's our first category. The one that's more interesting and the one that you're going to spend a lot more time on is the concepts of improvements to land. And under improvements to land, they talk about testing every distinct asset, right? And so they talk about those issues. These assets are going to be tested. Now, if you're trying to figure out if something is a distinct asset, because we test every distinct asset by itself, under the regulations, because we know every building's a distinct asset, right? Every structural component is a distinct asset, right? All those sorts of things are there. They say whether something is a distinct asset depends upon 4 factors in a fact and circumstances test. Whether the item is customarily sold or acquired as a single unit rather than as a component of a larger asset. Whether the item can be separated from a larger asset, and if so, the cost of separating it. Whether the item is commonly viewed as serving a useful function independent of a larger asset of which it is a part. And then number 4, the separating the item from the larger asset of which it is a part impairs the functionality of the larger asset. And that keeps you from doing things like trying to treat a single brick and deciding what is. No. Yeah, the brick really has nothing independent of the building it's in. So we're not going to let you kind of break it down that way. So we start looking at it that way. But when we look at improvements to land, here's how we start going with this, right? Improvements to land are two parts. That then gets in. So now we had a definition with four. Now we have a sub-definition of the second one that breaks into two. Improvements are inherently permanent structures, and buildings are in that list, as well as structural components of inherently permanent structures. So they give us a list of things that are automatically considered essentially a building. And that includes houses, apartments, hotels, motels, enclosed stadiums and arena, enclosed shopping malls, factories and office buildings, warehouses, barns, enclosed garages, enclosed transportation stations and terminals, and stores. Then they also give us a list of other things that would be inherently permanent structures. And some of them in that list are things like swimming pools, roads, bridges, tunnels, paved parking areas, parking facilities in general, other pavement, stationary wharves and docks, fences, advertising displays that are inherently permanent, for which the election under 1033G3 is in effect, railroad tracks, telephone poles. There's just a ton of things in this special list of other types of inherently permanent items. If your item is not in those lists, then we're back to a facts and circumstances test again. You know how we love facts and circumstances tests, right? Well, we're going to take a look at facts and circumstances to see if you have this is real property. And remember, the purpose for this is whether it could be like-kind property, can actually get in a like-kind exchange, or whether we're going to have to recognize gain or loss on it if we're getting rid of it, or is it non-like-kind property when we receive it. So it's not a minor detail. And when we start looking at this, the test we're going to look at is we're going to use 5 factors: the manner in which the distinct asset is affixed to real property, whether it's designed to be removed or remain in place, the damage that the removal would cause to the item itself or the real property which is affixed, any circumstances that suggest the period of affixation is not indefinite, and the time and expense required to move the distinct asset. Now, interestingly apart, while you think it needs to be attached to the building, in fact, they say that if in fact the item isn't attached, but is in essence inherently so big, so heavy that moving it would be unrealistic and impractical, then it could still be an improvement to the building. And one of the things they look at here was, one of the first examples they give us is a permanent sculpture, a huge permanent sculpture in a building that's not actually attached to the building. It's not part of, we don't attach it to anything, but is so big, so huge, and clearly a part of the building that they're going to consider it to be an improvement to the building. So it's interesting, some of the tests we've got. Now, a structural component is a distinct asset, so the same test is there, right? So it has to be a distinct asset, essentially, that is part of and integrated into an inherently permanent structure. And they're saying if interconnected assets work together to form an inherently permanent structure, for instance, systems provide a building with electricity, heat, or water, those assets are analyzed together as one distinct asset, which may be a structural component. There are some additional detailed rules for it. Generally, one of the things they tell us is, though, that any property that is machinery normally will not be a distinct asset. I should say not distinct, will not be considered part of the building. Even though it may be attached and look like it, if it generates income on its own, independent of just being able to let us use the building, then we have something here that will not necessarily be considered real property. One of the examples they give is they talk about one thing they do, this 3D printer that's big and huge and like bolted into everything. They're saying because that's being used to produce product, it's not considered real property for 1031 exchange purposes. So can't do that. But then they turn around and they talk about, they had a generator as well they put in the building. Well, the generator is machinery, but if the generator just generates electricity for the building in general, then it's considered real property. But in a second example, if the generator is there only to generate electricity for the 3D printer, then it is considered to be not real property. So we have, and there, by the way, there are 12 examples. This is a huge area. There are 12 specific examples that go into a lot of details. You want to study those. I've given you the list of them and kind of briefly summarized some of them, but you really want to take a look at that, especially if they're in areas that are similar to problems you're going to have looking at 1031 exchange. Some of the things that are basically, treated pretty much automatically as long as they're part of and integrated into a permanent item will be structural components. They list a ton there: walls, partitions, doors, wiring, plumbing systems, central air conditioning and heating systems, pipes and ducts, elevators and escalators, floors, ceilings, permanent coverings of walls, floors, and ceilings, insulation, chimneys, fire suppression systems, including sprinkler systems and fire alarms, fire escape, security systems, humidity control systems, and the catch-all other similar property. If it's not clear, they're not in that list. Again, another one of these facts and circumstances tests. This is a 4-factor test. They talk about the manner, time, and expense of installing and removing this component, whether the component is designed to be removed, the damage that removal of a component would cause the item itself or the inherently permanent structure which is affixed, and whether it's installed during construction of the inherently permanent structure. So you take those 4 factors, and that's how you kind of decide if you have a structural component. Now, the next line is kind of interesting, and this comes up a little differently, but it does solve a problem if you're trying to exchange farmland, and the crops in the ground. The ruling do tell us that if you have unsevered, and the term here is unsevered natural products of the land, so that could include, for this purpose, they talk about here, growing crops, plants, and timber. It also could be mines because there's ores in there. It could be wells, there's oil under the ground. Or it could be other natural deposits. We're not going to run into trouble because our land includes that sort of thing. We can still do a 1031 exchange, but the key caveat is once the crop's been harvested, once the timber has been cut, once the ore has been taken out of the ground, at that point, that stuff ceases to be like-kind property, ceases to be real property, so it can't participate in like-kind exchange. So it has to remain, that's why the term unsevered. It has to remain part of the land in order for you to be able to use this. The final category that they look at here for what's land or what's real property is they talk about intangibles. Oh, I should say, not the last one, I missed one here. Water and airspace adjacent to the land. That's primarily of use if we're talking about like dock areas, where you have a lake. We're not going to worry about how much of the lake you've got. That's not technically land. But if you have water or airspace that is there, yeah, we got to do that. As long as it's adjacent to the land, we're doing, it's considered real property. What that does tell us is if all you had was a right to airspace, or if all you had was a right to some part of the water, the lake, whatever, that apparently would not be considered to be real property for this purpose. That would be a little differently. Finally, right, we look at that. Now we also have another category that we're going to look at here. They talk about here intangible assets as real estate. And in this case, we're talking about certain rights. And what they've got here, they have an interesting pair of examples for this. Let's say I'm a cell phone company. I negotiate a license with the federal government to be able to install a cell tower on their land. Now, I don't own their land, right? I don't get ownership of the land. That is not, but they're saying, but that right to use the land is considered real property for 1031 purposes. Conversely, let's say I am getting ready to open a casino, and I get a license to open a casino. That license is tied directly to this location. I can't take that license and go somewhere else. That license is good for this location only. If I want to relocate my casino, I need to go get a brand new license. Because I own the land, right? The land itself is owned, and that just affects the use of it, of something that I own. That is not considered to be an intangible asset that could be exchanged. So if you did a 1031 exchange on, let's say, a casino, and you had the license could be transferred at the same time, transferring that license would be non-like-kind property. And definitely there would be value in that property. So, yeah, we have an issue there. Now, one final thing they did, they added a safe harbor on personal property. And the catch was some people got very concerned, especially for deferred like-kind exchanges. What happens if, I go get an office building, and the intermediary goes and acquires, as part of the office building, they acquire the office building, and they get whatever type of, basic personal property is inside the building. Is that considered to blow my exchange? And under the regs we had before, it appeared possible that your exchange could be blown sky high by having that other property acquired by the intermediary. What these rules provide for us is they make a change to the regulations. And the change they make is to regulation 1.1031K-1. Right, we're going to make some changes that say essentially, so long as under this rule we get an exception that the personal property is going to be considered incidental, so long as the personal property does not exceed 15% of the aggregate fair value of the replacement real property. So your intermediary could take an office building, and as long as the value with property in it, as long as the value of the property in the personal property inside the office building is not more than 15%, we have not blown the exchange entirely. That was a concern. You could blow it entirely. We're still going to have apparently disqualifying property, which means we're going to recognize some gains on this, or we're going to have some boot. But, it's not going to be considered a major problem. Now, the test here we do have this to be incidental. It's got to be one where in a standard commercial transaction, the personal property is transferred together with real property, and that aggregate amount does not exceed 15%. The IRS also provides a separate example of when this would be covered. So bottom line, now these are proposed regs, but unlike the last set, we talked about medical, they never said we could rely upon those right now. But in this case, for the 1031 exchange, these we can rely upon for exchanges from 2018, after 2017, all the way up until these regs are final. So, and since we don't have a lot of other guidance, it says that probably prudence suggests that you would take a look at these. Now, since they're proposed only at this point, you wouldn't have to follow them, but you'd have to be able to justify your position otherwise. If you do follow them, it's kind of like a safe harbor. As long as they meet these tests, we're good. So, it's one of those things. Well, we're getting actually the point we're going to stop a lot of CPE because we're getting close to what is now our out of the blue brand new due date of April the 15th. But I do have a few more courses coming up over the next couple of weeks. This week, I will be doing a 4-hour tax update for over the past couple of months for the New Jersey Society. We will definitely be talking about the PPP loan program. What's happened there over the past couple of months. I did an update for New Jersey on PPP loans back in the early part of May. We're going to basically look from what happened then going forward, but we're going to cover other tax developments. We're going to be doing this on a kind of monthly basis for New Jersey. So we'll keep covering what's gone on and discuss in some more detail. Also going to be doing, for Oregon Society CPA, I'll be doing a FASB and AI CPA update. I'm in the Gap world for a day, so I'll be there on the 18th. That'll be an all day. And again, all these sessions are online. And finally, I will be doing basically CARES Act and now, Payroll Protection Program, Flexibility Act update plus other developments since the beginning of the year. That's the 8-hour I've done before. That'll be on June the 23rd. Again, virtual for the Illinois CPA Society. So if you're a member of any of these societies, you want to take a look at those, sign up for them. I'd be glad to see you online, and we can have cover the topics in question. But go ahead, check in, and we'll do that over the next couple of weeks. And then I think everybody's going to start focusing heavily. From that point forward, everybody starts focusing heavily on, the April 15th deadline coming 3 months after the April 15th deadline. So it's been kind of interesting. Well, this has been Current Federal Tax Developments for the week of June the 15th, 2020. Current Federal Tax Developments are brought to you by Kaplan Financial Education, your stateside CPAs. If you have any questions, you can email me, edzollers@currentfederaltaxdevelopments.com. You can follow our written updates on the website every day. Not necessarily every day we'll have an update, but we do quite a few of them during the week, and that'll be at www.currentfederaltaxdevelopments.com. Certainly as we get new PPP loan IFRs that are modifying us for the new law, we'll see things there. I am on Twitter. You can follow me there. My handle there is @edzollers. I do follow along on a number of public discussion forums. You can find me on the Connect sites for Arizona, New Jersey, Illinois, and Minnesota. So you can follow me there. I will try to pitch in there if I think I see something I can help with. So if you have questions, you can go there, and they're very useful places to find out things. I also follow along the Cal CPA Tax Talk group. If you want to go look in there, that's open to any CPA around the country. And finally, you can find me sometimes looking in on the subreddit /r/taxpros issues that come up there. Well, like I said, hopefully you're ready to go. Hopefully you've got everything under control, and hopefully you're ready to start this brand new fun season. So have an interesting week. Get ready for the due date. We're going to be 1 month away now from the April 15th. It's now July 15th. But go ahead, take a look. We'll try to keep up with what happens here and be ready to join us back here next week with current federal tax developments.